Allow me to paint a picture for you. An investor takes a dart and throws it at a wall full of different investment choices. Well, over the last decade, they were bound to hit a winning choice. You see, even the most unthoughtful and disorganized investment strategies were actually doing pretty well over the last decade. But the moment is finally here. We have been talking about this for a little over a year now, and we're finally starting to see markets have their drawdown. The S&P closed today down almost 17%, which is really significant. That's almost bear market territory, and we could very well be into a bear market by the end of this week. Fortunately, we have some really great tips for you today that will help you be smarter with your money during this time. Welcome back to thefedcorner.com, where we're helping federal employees make better financial decisions every day. Before we go any further, as we always do, there is a full article that accompanies this video. We go much deeper into the article, so we're going to leave the link below for you. It's imperative that you look at that article and get all of the information that we're putting out. So here we go. Most people over the last 10 to 13 years have been successful investors simply by picking a handful of index funds, allocating their portfolio as is, and pretty much looking away. Well, this strategy might not pay off anymore. We've been talking about how markets are cyclical over the last year, and we've been approaching very slowly a new cycle in the market. And smart investors first have to understand how index funds work. The first thing you need to know is that index funds are a measure of different parts of the market. They're designed to participate in all of the market swings, both up and down, relative to the portion of the market that index is designed to track. Now, this diversification can offer you a lot of opportunity in the long term. Understanding that level of volatility in the short term presents a real risk to you. If you have a really long time to grow your portfolio, like you did when you first started working as a federal employee, you started to invest in the TSP, this broad diversification and large market swings are part of the reason that over this very long career of yours, you've accumulated a significant amount of assets. But if you're at that phase now where you're approaching retirement, you're late career, or perhaps you're actually already retired, you really need to consider a different type of asset allocation, because like we talked about just a minute ago, those large index funds, they're going to participate in all of the swings, both up and down. And really, you don't have time anymore to recover from a gigantic dip if you fall all the way down with the index funds that you're in. Remember, the goal of your portfolio is so that it can continue being large enough and generate income between now, when you stop working, and the rest of your life. So if that's the goal, creating some sort of preservation around the assets that you've worked really hard to build, you can begin to see how the large swings that the index funds provide you will present a challenge for that. Now, understand, I'm not saying index funds are bad. In fact, we use index funds in nearly all of our clients' portfolios, but you have to truly understand how to best use an index fund. Simply using a fund versus executing on proper use of a fund are two very different concepts. Using indexing in your portfolio, you're going to get some of those volatility like we talked about. You have to be able to strengthen your emotions to be able to deal with that type of volatility. There's this really great graphic that we like to show our clients. I've shared it before, so if you've seen some of our videos, you've seen this graphic before, but it's so applicable here in this moment too. So we're going to throw it up on the screen and let's talk about it together. This blue line you're looking at represents a stock market in its whole. So prices are going up, prices are falling, and each dot that's plotted along the way are emotions that investors feel along the way. So we can see here as the stock prices are going up and the markets are going up, people's portfolios are doing very well. People are feeling really great. You're not subject to that emotion. Well, as things start to go south like they are right now, we start to get denial and fear and desperation and panic. And really, we start to see investors begin to abandon that philosophy of index investing. Because remember, indexing means you're going to have a lot of that volatility, especially if you're only just using, very few of the major indices. We start to see investors say, you know what, maybe the markets just aren't for me. And this is a core fundamental change in an investment policy that can really destroy your portfolio. You have to understand and begin to fortify your emotions so that you can continue to either right at this point or anywhere along here, readjust your portfolio as needed so that you can effectively participate in the markets when they do come back up again eventually. Now, it's important to understand there's never a guarantee that markets are going to return. There's never a guarantee that your investments are going to return, especially if you are picking stocks all over the place. One of the great things about index funds is that they do offer a high level of diversification so that if any one of those companies does go out of business altogether, you're still able to participate in a lot of other companies going up. But you know what? We can't predict the future. I will say, if this is really the end, then your portfolio is the least of your worries. Maybe you should go count how much gold you have in your basement. The point that this graphic is trying to show is that investing successfully over a long period of time is a skill. A change in attitude can cause investors to begin to start making poor choices. One of the ways this manifested itself, we saw a lot of people move all the way to the G fund because they were scared of what was going to come. They just wanted to stop their losses there. The problem is that it's really difficult for you to get back into the markets again. And that poor decision will prevent you from being able to have the opportunity of participating in the growth of the markets again. There have been Nobel Prizes won in behavioral economics because as human beings, we are really great at rationalizing with ourselves. So as things are falling apart, we're looking at our portfolio, we're making decisions, we might be convincing ourselves that what we're doing is actually for the better, when in actuality, we may be doing more harm than good. Okay, so the next thing that is imperative that you do in 2022 to make sure your portfolio is solid is you need to begin to address your sequence of returns risk. What is that? Well, a sequence of returns risk is exactly what it sounds like. If an investor experiences bad returns a few years approaching to retirement, or as soon as they retire, and they are also drawing heavily from that portfolio, the double whammy that hits your portfolio is so great that it can really cause a big torpedo to just blow up your financial safety. I don't mean to be dramatic, but this is one of those things that causes retirees to run out of money before they run out of time much sooner than they would have anticipated. In the article that I mentioned is linked below. Go check that out. Make sure you're gathering all the information we're putting out. There's a link to another article that addresses sequence of returns risk more deeply. There's an example of a portfolio and what it could look like in a circumstance like this. I think that's going to be really helpful to you, so make sure you are checking that out. So how does a federal employee address sequence of returns risk? Well, simply put, with proper asset allocation. I know, not as specific as you might have liked, but let's talk this out. If you are too aggressive in certain parts or swaths of the market, then you might be forced to take losses in your portfolio when you really didn't need to. The problem is not necessarily the fall, but how long will it remain down? Going back to index funds. In 2008, the S&P 500 was down for a number of years before it actually returned back to its base value. Do you have that time to allow yourself to recover? What are you going to be doing about income in the meantime? Now, you will have your pension. Many of you will have Social Security as well. You may even have a special retirement supplement, but it may not be all that you need. And so if you're drawing from your portfolio as well, you really need to make sure that your asset allocation is set up in a way that it will provide you with the income that you need so that you're not tapping into the investments that have just fallen out of the sky. One option for you is to maintain a heavier asset allocation within cash or cash equivalents. Many people consider cash, oh no, that's not really part of an investment. Yes, it is. It's a part of your portfolio. Maintaining a cash position is as much part of your asset allocation as how many stocks and bonds you have. Historically, the traditional advice is in a recessionary period, somewhere around 1.5 to 2 years, people may lose their jobs, you need to have a lot of cash. As a federal employee, that's not really a risk to you, and so we recommend somewhere around 12 months of cash reserves because you really cannot predict what the markets will do. And it's also important to know that if you're holding that 12 months in cash in the G fund in your TSP, the TSP has a feature that it does not allow you to only access the G fund when markets are down. I absolutely dislike this feature. I don't know why they have this. When you go to withdraw money from the TSP, they will sell proportionally across all of your funds. This is a really big challenge in portfolio management. When markets are volatile, we want to be selling from assets that have not fallen so deeply, such as cash or maybe some of those fixed income investments. Well, in the TSP, it's going to sell across all of your assets, including the C fund, including the S fund, including the I fund. Those are funds that will have struggled and have struggled this year. So you really need to be planning your cash flow needs well ahead of time and determining your moves appropriately. Some other considerations that we've been talking to our clients is we're really starting to look for areas of opportunity. For example, in 2008, We had technology that had fallen out of the sky, and financials were doing really badly. Well, those proved to be unbelievable places of opportunity to be able to ride the markets back up. So you want to be looking at investments that make sense once things are not doing so well and start deploying that money. If you're not already investing to the maximum in your TSP and you're able to do more, please consider doing that. That's one of the things where you're buying things when things are on sale. You're buying those investments as they're down and you have the opportunity to ride them back up. So be tactical about where it is that you're investing, because it's not everywhere that will do well, especially if we head into a recession. The next thing is you should really be considering some of your investments that are in non-retirement accounts too. Well, what am I talking about? There is tremendous opportunity right now to be tax loss harvesting. This is a technique that we do in a portfolio to help reduce capital gains for our clients. Some of our clients have historically experienced thousands of dollars saved in capital gains. Now, your experience is going to vary. It depends on your investments. It depends on what's going on in the market. But just understand that both paying excess capital gains as well as the opportunity cost of not being able to redeploy that capital and reinvest it, that can be a very big windfall to investors that are doing this appropriately. And finally, you need to understand how bonds work, the relationship to interest rates, and how they may fit in your portfolio. Now, there are some bonds and fixed income instruments that are more appropriate for an environment like this. These are things like TIPS, these are things like higher yield bonds, these are things like very short duration bonds. Now in the TSP, this is going to be the F fund. Unfortunately, you don't really have choices about what goes into the F fund. It's picked for you, but it's better than nothing. While you're still working and you don't really have other options, that's a way that you can begin to reduce some of that volatility. Although understand at this point, going more conservative after we've almost reached a bear market, if there's further to fall, it will help dampen that fall. But as a result, it will also dampen the growth on the way back up. So really understand the trade-offs and how that relates to the goals that you're trying to accomplish. Maybe you have enough and you're already perfectly fine just preserving your assets. Maybe you don't, and you need to be a little more aggressive. You can't know unless you go through the exercise of developing this retirement plan and really setting yourself up for success. And if you're not certain how to do it, you don't have time, the wherewithal, you got other more important things. We work a lot with senior executive service, so we understand you have no time at all, ever. And so these are the things that you want to consider working with a firm that you trust and a group of advisors that understand your federal benefits, understand how all of these things come together, and are acting in a fiduciary capacity to help you achieve these retirement goals that you have. Make sure that you're taking the time to do it correctly or working with a team that can help you do this, because it's not just your money, it's your future. If this was helpful to you, maybe it's helpful to one of your peers too. We love it when you're sharing our content. It really helps us to understand the types of things that you guys are looking for. And perhaps you want to consider subscribing too, so that you're getting notification of all of these things that we're doing. As the markets accelerate towards more bear territory, we're going to be coming at you with more stuff like this. So you want to make sure that you're taking advantage of everything that we have to offer. And that's all we're going to cover on this video today. Like I said, make sure you're looking at the article. Guys, I cannot stress this enough. We dive much deeper into all of these principles. We talk about other things. There's more links. There's a lot of important information. We're going to put the link below in the description so that you can go and check that out. So be in touch if we can be helpful to you, and we will see you next time.